The IRS just released the new 2026 tax brackets, and millions of taxpayers are about to pay less in taxes on their next tax return. Not because they earn less, but because these new brackets allow you to report more income at lower tax rates. You'll also see a higher standard deduction, which means less income taxed overall. Investors will be able to report more capital gains at lower rates as well. And for those who love saving money, you'll be able to put more money into your HSAs, retirement accounts, and other tax advantage accounts as well. As someone who has already reviewed the IRS codes and guidance behind these changes, and as a licensed certified public accountant who does tax planning every single day, I want to give you a simple, clear understanding of how these 2026 changes may affect you. So let's jump right in. First, let's clear up one of the biggest misconceptions I see every single year. A lot of people think that if you're in the 22% tax bracket, that means all of their income is suddenly taxed at 22%. That's not how the US tax system works. And this misunderstanding alone causes people to overestimate how much they owe. Here's a simple way to think about it. Think of tax brackets like buckets or layers stacked on top of each other. The first portion of your income goes into the first bucket or layer and gets taxed at the lowest rate. Once that bucket fills up, only the extra income spills into the next bucket and gets taxed at that next rate. So even if you're technically in a higher bracket, most of your income is still taxed at lower rates. In 2026, federal tax rates still range from 10% all the way to 37%. But how fast your income moves through those buckets is what actually determines how much taxes you pay. And this is exactly why understanding brackets is very important, because tax planning isn't about avoiding income. It's about controlling where that income lands. Now, let's walk through the 2026 tax brackets for single taxpayers, because this is where understanding the numbers really starts to matter. And as I go through these, don't get caught up trying to memorize every single dollar amount. What I want you to focus on is where the big jump happens. So for single filers in 2026, you pay 10% on the first $12,400 of taxable income. Then 12% on the income above the $12,400. Once your taxable income goes above $50,000, you move to the 22% tax bracket. Above $105,000, that income is taxed at 24%. Then once your taxable income crosses about $201,000, the tax rate jumps again, this time to 32%. After that, income above $256,000 is taxed at 35%, and income above $640,000 is taxed at top 37% rate. Now here's the part most people overlook. The first major jump happens when you go from 12% to 22%. That's not a small change. That's a 10% point increase in your marginal tax rate. This means for every additional $10,000 you earn in that range, you could be paying about $1,000 more in federal taxes. This is usually where people start feeling like, wait, why did my tax bill jump so much this year? But the second jump is the one that really gets people's attentions. When your taxable income increases about $200,000 as a single filer, your marginal tax rate jumps from 24% to 32%. That's an 8 percentage point increase, and that's usually when clients reach out to me. Because at that point, taxes stop just being an annoyance and start becoming a serious expense. And once you're in that range, every additional dollar you report is being taxed much more aggressively, which is exactly why planning ahead matters. Now, let's talk about married taxpayers, because this is where the tax system quietly becomes much more generous. If you're married filing jointly, you can fit significantly more income into the same lower tax brackets compared to single filers. And this surprises a lot of people when they see it for the first time. For married couples filing jointly in 2026, here's how the brackets work. You pay 10% on the first $24,800 of your taxable income, then 12% on income above that $24,000. Once your taxable income goes above $100,000, you move into the 22% tax bracket. Above $211,000, that income is taxed at 24%. When your taxable income crosses about $403,000, the rate jumps to 32%. After that, income above $512 is taxed at 35%, and income above $768,000 is taxed at the top 37%. Now, here's why this matters. In many cases, married couples can earn nearly twice as much household income before hitting the same rates as single filers. That means two people earning income together can often stay in lower brackets longer, even if their combined income looks high. This is why married taxpayers are often shocked when they compare their tax situation to a single friend earning a similar amount. I've had clients tell me they've never realized how much of a big difference this was until they actually saw the numbers laid out. And whether you're married now or not, understanding this helps you plan ahead, especially if your household income is growing. Just like with single filers, there's a point where taxes really start to accelerate. For married couples, that usually happens once household taxable income crosses about $400,000, when the marginal tax rate jumps from 24% to 32%. That's typically when taxes go from manageable to something that requires real planning. And once you're in that range, the difference between no plan and smart planning can easily mean tens of thousands of dollars over time. Now, you might be thinking, okay, these are the 2026 brackets, but how different is this from last year? And this is an important question and important distinction because small changes in tax brackets can create real savings. See, every year the IRS adjusts tax brackets for inflation. That means the income limits from each bracket usually move upward, even if your income doesn't change at all. So for 2026, these inflation adjustments allow you to fit about 3% more income into each tax bracket compared to prior year. And here's why that matters. Let's say you earned roughly the same income in 2025 and in 2026. Even without earning a dollar more, you could still owe less in taxes in 2026 simply because more of your income stays in lower brackets. This is one of those changes people rarely notice, but it quietly helps millions of taxpayers every year. For someone sitting near the top of a bracket, these adjustments can be the difference between staying in the lower rate or spilling into the next one. And once you spill into the higher bracket, every extra dollar gets taxed more aggressively. That's why these inflation adjustments matter most for people whose income is growing or fluctuates year to year. When you understand that brackets move each year, you can make better decisions about timing, when to recognize income, when to trigger capital gains, when to accelerate deductions. Instead of reacting at tax time, you can plan ahead and let the system work in your favor. Now, let's talk about the standard deduction, because this is one of the most important and most overlooked parts of the tax code. See, about 90% of taxpayers take the standard deduction, and that means for most people, this one number alone determines how much of their income is even subject to tax. So for 2026, the standard deduction increased again, and here are the numbers. So if you're single, the standard deduction is at $16,100. If you're head of household, it's at $24,150. If you're married filing joint, the standard deduction is $32,200. What this means in plain English is that the first portion of your income up to these amounts is not taxed at all. A higher standard deduction means less taxable income, and less taxable income means less tax owed before we even start taking credits or investments or advanced strategies. So for someone in higher tax brackets, even relatively small increase in their standard deduction can translate into hundreds or thousands of dollars in tax savings. And because these deductions increased again in 2026, many taxpayers will automatically owe less without changing anything. Now, some people still itemize deductions, but here's the key point. When the standard deduction goes up, your itemized deductions have to be even higher before itemizing makes sense. So for many taxpayers, especially those without large mortgage interest or charitable contributions, the standard deduction is now the better option. That's why it's so important to review this with your CPA each year, because the best choice can change as these limits move as well. Now, let's talk about capital gains, because this applies to anyone selling investments, real estate, or other assets. A capital gain happens when you sell something for more than what you paid for it. So for example, if you bought a stock for $40 and later sold it for $55, that $15 difference is your capital gain. Now here's where the tax treatment changes. If you sell an asset you've held for 12 months or less, that gain is taxed as ordinary income, meaning it's taxed using the same brackets we just went through. But if you hold the asset for more than 12 months, it qualifies for what we call long-term capital gain, which is taxed at a lower rate. And that's where 2026 changes come into play. For 2026, long-term capital gains are taxed at 0%, 15%, or 20%, depending on your income. And here are the thresholds. So if you're single, you pay 0% on long-term gains if your income is up to about $49,000, 15% on gains up to about $545,000, and 20% above that. If you're married filing joint, you pay 0% gains if your income is up to about $98,000, 15% up to about $613,000, and 20% above that. See, these thresholds increased again for 2026, which means more people can qualify for lower capital gains tax rate than before. This is where tax planning becomes extremely powerful because it's not just about how much you earn, it's about when that income or gain shows up on your tax return. Someone in a high income year might choose to delay selling an asset, while someone in a lower income year might intentionally trigger gains. And I've seen these situations where simply timing a sale properly saved clients thousands of dollars in capital gains tax without changing the investment itself. And remember, capital gains stack on top of your other income. So selling an asset in a high income year can push more of your income into higher brackets. That's why understanding both ordinary income brackets and capital gains thresholds together is so important. When you plan them together, you keep more of your returns. Now, for people who love saving money and lowering taxes, let's talk about HSA and retirement contributions. These limits increased again in 2026, which means more money you can shelter from taxes. For HSAs in 2026, if you have a self-only coverage, you can now contribute up to $4,400, which is up from last year. And for family coverage, it's $8,750, also an increase. That might not sound dramatic, but every dollar that goes into an HSA is tax deductible, and that adds up over time. Now let's talk about retirement accounts. In 2026, the 401k employee contribution limit increased to $24,500, and IRS increased to $7,500. Again, small increases, but real money. And when you combine these higher limits with smart tax planning, this is how high earners legally reduce taxable income year after year. At the end of the day, tax brackets don't punish people for earning more. They punish people for not planning. The rules are already written. The brackets are already set. The only question is whether you're using them intentionally. If you're in a high tax bracket right now, or you feel like your income keeps growing, but your tax bill keeps growing faster, that's not something you fix with guesswork or a random software. That's exactly what we help clients do every single day. If you want a clear legal strategy that reduces what you pay in taxes, not hypotheticals, not shortcuts, you can apply to work with our team. Go to yourtaxsavingsblueprint.com. The link is also going to be in the descriptions below. We'll look at your numbers, your income, and your situation, and show you what's actually possible. Make sure you're subscribed to stay up to date, and share this with someone who could benefit. Thanks for watching. See you on the next episode.